This video was made in partnership with the Daily Upside. Visit the link in the description to learn more. Paying money to lose money. Hey, Vsauce, Ben here. What if I told you there was a place on the internet you could go that allowed you to pay real money for financial advice that will make you lose thousands of dollars? Alright, here's the plan. I want to find a trading strategy on Fiverr and turn it into something that actually has a chance of making money. I will teach you risk-free, massive, profitable day trading strategy. She made my day. After a lot of frustration, she gave me peace. This sounds more like a love story. She is patient, very kind, and good part is because she had video and other stuff on the package to facilitate everyone to understand clearly. I am grateful, definitely I recommend. Cute. I will stock market intraday trading futures options profitable strategy course. No way. I was looking for someone who could stock market intraday trading futures options profitable strategy course. It's like he just jammed every finance keyword he could think of into this title indiscriminately. This is a new frontier of search engine optimization. Fiverr.com, a place where you can actually pay to lose money. The graphic design of these listings makes me want to throw my computer out a window. $40 for option callouts. Alright, let's buy this. Okay, so hopefully by market open tomorrow we'll have some good callouts. We actually do have some callouts this morning. One for pen, one for Nvidia. The pen callout, I think it wasn't setting up right or something, so we didn't activate the trade. The Nvidia one, I just decided to wait through and see what happened, and it hit the stop loss. Bested by market volatility again. I'm not sure how many days we get these trades, but it looks like at least 2. Hopefully tomorrow will be better. Fiverr, you can't blame it. Fiverr is more meant for creative stuff. I just don't think anyone that makes profit gives away their trades for $40. Why would that make sense? I don't know why though. It's so funny to think about giving away a literal money printing strategy for $40. Like, that's just such an arbitrary amount. I just picture the whole team sitting in a room. Okay. Years we've worked to develop this strategy. Thousands of back tests. Thousands of hours studying the intricacies of the market. How much should we charge for it? And then it's like the new intern in the back that worked on it for 3 days. What about like $40? $40. I like that. Like they didn't even want to round to 50. $40 money printer? Bargain. But 50 won't go near it. I can assure you, if these callouts actually made money, more than 15 seconds of thought would go into setting the price. But then again, nowhere in here does it say they will be profitable. I will provide you with option trading calls. Just, yeah, I'll give you option trading calls. No idea if they're actually going to work. There's really no theory or strategy behind it. But if you want for $40, I will tell you which incredibly risky short-term option contract you should put your hard-earned money in. Honestly, I have no problem with this. It's not like there's any deceptive marketing here. Provided option callouts as described, 5 stars. Speaking of Janet Yellen overstating the frequency of illicit crypto transactions, I had to shoehorn that in there somehow, I'm sorry. The Daily Upside is a free financial newsletter that talks about business, economics, and finance. Personally, one of my favorite activities is reading the Daily Upside in the brief 10 minutes of peace before I check my portfolio in the morning. It always seems to soften the blow a little bit. The Daily Upside is the only financial news source that gives you relevant information without headlines about the inevitable implosion of the global economy. Take for example this article about crypto that will now be used as my ammunition next time an old person says my Bitcoin position is fueling the black market. Most importantly, it doesn't take itself too seriously and offers concise information that doesn't waste your time. You can subscribe to the Daily Upside using the link in the description. It's 100% free and you can always unsubscribe if you don't enjoy it. Maybe stock trading calls? I will take your Forex and stock trading and make money investing. I don't know what that means. I will teach you to trade basic option Greeks. I believe you could teach me that. I just want to reach out to this guy and say, I think it might help your business if you put something related to options trading in the thumbnail. Maybe he's going for more of like a pragmatic, cold accountant look. The guy who's brilliant but doesn't like human interaction. It looks like someone has bought this. Watch, this is probably all some meticulously calculated marketing strategy. I want to find a trading strategy on Fiverr and then take the theory and turn it into something that actually might work. Probably should have gone to Upwork instead. Fiverr is Walmart, Upwork is Target. In both cases, There's gotta be some kind of joke there, I just don't know what it is. Fiverr is the younger brother that started smoking weed a few years too early. He's artistic, but he probably works at Subway too. I will share my profitable stocks and options trading strategies. 8% in the past week, 44% in the past month. Those are some good returns. It looks like this gives us the trading strategies in PDF form, which should be good. We received the PDF just in time for market open. The two strategies outlined were call credit spreads and covered calls. Just a very basic explanation of each of them. Honestly, it's exactly what you'd expect from a $10 informational PDF about options trading from Fiverr. Who could have ever predicted? It doesn't tell you how to find which stocks to make these trades on, which you'd think would be an important part of getting that 8% weekly return. But maybe you're just supposed to do something like this. Okay, so the PDF from Fiverr gives a really basic explanation of selling covered calls and selling call credit spreads. What it doesn't give you is a way to find the opportunities where you're supposed to use these strategies. Using the random stock picker is an option. You might even make money in the short term, but you will always lose money in the long term when considering the efficiency of the options market and the cost of getting into your trades. Instead, maybe we can find where the options market, for one reason or another, is mispriced. That way we can figure out some strategies like the ones described from Fiverr to capitalize on it. Bed Bath & Beyond. Earnings miss, supply chain problems, whatever. But the interesting thing is this increasing divergence between implied volatility and realized volatility. If we plot the ratio between implied and realized volatility, we can see that it has periods where it moves apart, but always tends to normalize around 1. Hence the efficiency of the options market and the fact that everything is fucking priced in everything. Or is it? This drop right here is the decrease in IV from earnings, but we're still trading at almost 30% above our normalized level. Implied volatility is directly influenced by option demand. It's volatility implied by the options market. So a more intuitive way to read this is that option demand and thus option prices are increasing. And if prices are increasing despite no material change in the width of the distribution of outcomes for the underlying, that means we can sell them, and our expected value for the trade is the difference between the market's option prices and our determined fair value of option prices. How do we figure out the fair value of option prices? I don't know. Yet. I don't know yet. These two will converge. That's a certainty. We just need to make sure this green guy is gonna go in this kind of trajectory, and this blue guy is gonna stay down here. Which, I don't know, when you draw it out like that, it almost makes it seem like it could happen. I finally understand the appeal of technical analysis. Another interesting thing to look at is our skew. That's just a fancy way of talking about whether out-of-the-money puts or calls are more expensive. With the way volatility trends, out-of-the-money puts tend to be more expensive than out-of-the-money calls. Stocks usually move upward slowly and then drop violently. We can see this reflected in the skew of a stable company like Apple. With Bed Bath & Beyond, we actually see the opposite, which is strange. Especially when you think about options as insurance contracts. And when I say insurance, I don't mean ensuring that you'll lose all of your money. Usually, out-of-the-money puts are more expensive, because if you're actually looking to protect your money, instead of donating it like I am, your risk is in these violent drops that happen every once in a while. So think about how counterintuitive this is. The options market is implying right now that there's more risk that Bed Bath & Beyond will tank up. So who could be driving up these call prices? Well, fund managers don't usually gamble with out-of-the-money calls. So if I'm making a prediction here, I'm saying that this is driven by retail hype. Message volumes on StockTwits almost up 200%. Bed Bath & Beyond mentions up on Ape Wisdom. I personally don't think we're gonna see enough momentum to realize this volatility. Watch, somebody's gonna clip that and turn me into a meme when it goes up 300% in 2 days. After thorough analysis, I can say with 100% confidence that volatility is probably maybe overpriced, I think. I decided to open an Iron Condor. This allows us to bet that volatility will fall in the coming weeks. After a few days, our prediction played out as anticipated. This green guy did continue to go down, and we made money. But there's one problem. How do we know it worked for the reasons we theorized? I can tell you that this skew fell back to a lower level, and based on its correlation to message volume on StockTwits, you could assume that out-of-the-money retail call volume caused... Wait. We can't say that. They're definitely correlated, but we don't know for certain that retail volume caused anything. It's an educated guess at best. In actuality, it's probably degenerate risk-taking. So how do we know what's causing what? Are we just supposed to assume it's working for the reasons we think it is? That's not a rhetorical question, I'm actually asking you. Well, until we figure out the answer, degenerate risk-taking will have to do. I'm guessing that's not a problem for most of you.